Hey everyone, my name is Ian. If you've been around here for a long time, many of you know that I have been investing in dividend stocks for over 20 years. I have been creating wealth through long-term investing in dividend-paying stocks for a long time right now. And so many people out there consider me an OG, if you will, within the dividend investing community. But there's someone out there who's been doing it a lot longer than me, and his name is Peter Lynch. In my opinion, Peter Lynch is the greatest investor of all time, and this is part 2 of my book review of Peter Lynch's book, One Up on Wall Street. And so in my last video, in part 1, I shared 10 lessons from his book. Today's video is a bit more lengthy. I actually am going to share 24 different lessons from One Up on Wall Street. And so if you'd like to follow along at home, please go ahead and smash that like button. And also don't forget to subscribe to my channel. I have so much great content on the way. You really don't want to miss out. And after you've done that, check out the pinned comment below and also the description. I will link to a free document that you can download and follow along at home, where I outline all 24 lessons from Peter Lynch's book. I am really excited, everyone. I have a really fabulous video today. A lot of insights from the king himself of investing, that is. I love you all. Let's get started with another dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, so I hope you all went ahead and checked out that free PDF file that I have linked to below. Follow along at home. I want to jump right into it. So the first lesson today, it's actually going to be lesson number 11 because I covered the first 10 in my last video, which I'll also link to in the description below. Let's go. So check it out on the screen. And what you see right now is that Peter Lynch really shares with himself and with those reading the book that it's important to have realistic expectations, especially as it pertains to kind of core stocks. He calls them stalwarts. I call them my ride or die stocks, my core stocks. Certainly within the core stocks, some of them are more aggressive growers, like Starbucks, for example. That I consider a more aggressive core stock, but there's other core stocks, for example, that are growing a lot slower. I would say an example of that, at least right now, at this time in history, is Coca-Cola. And so he basically says big companies oftentimes have smaller moves. And so, of course, certain of them will be outliers. Certain of them will perform better than others, like Starbucks. But Peter Lynch goes on to say there's nothing wrong with Procter & Gamble or Coca-Cola. And recently, both have been excellent performers. But you just have to know that these are big companies, so you won't have false hopes or unrealistic expectations. And so I thought this was a really good quote from Peter Lynch. And what I've found with these big companies, these core companies, I try not to fool myself. Honestly, they're the core of my portfolio. They hold it down. They pay the predictable cash flow, and they keep my volatility at a minimum. But I know that over the long term, some of my core stocks will perform better than others. And it's funny that he mentioned Procter & Gamble here, because that's one that's just shot through the roof, if you will, during these pandemic times. But even before that, it's been doing really well now for the last few years. I've been in Procter & Gamble for a really long time. And so we'll get more into the stalwarts, as he calls them. I call them the core stocks as I go through the video today. And so next, check it out on the screen right now. I want to go into the next lesson from One Up on Wall Street, which is lesson number 12. And he goes through basically this stock categorization. And so if you've been following my channel now for a while, you know that in one of my recent videos, I really categorized my stocks based on a flow chart that I shared with all of you. I'll show that on the screen right now. It's a really cool flow chart. I'll also link in the description below to that video so that you can check out my categorization. And basically, Peter Lynch, he does the same thing. He likes to categorize his stocks as well because it helps him think through things very easily. And so your categorization at home is going to be unique to you. I have my own, Peter Lynch has his own, but the takeaway here is that everyone should have their own way of categorizing stocks because it helps us sort through all these different ideas and assemble them into a logical long-term portfolio. And I think this is especially important for dividend investors because the point of dividend investing is to create wealth, long-term wealth, wealth that can outlive even those watching the video right now. We're creating, well, at least the way I'm looking at it is I'm creating a business of sorts that will last on through the ages. And to do that, it's important to assemble a team of stocks that works really well together. And so anyways, check it out on the screen right now. I want to go through Peter Lynch's categorization really quickly. He talks about slow growers. He looks at these as utilities, for example. He looks at stalwarts like Procter & Gamble, for example. And it's interesting that he considers Procter & Gamble a stalwart because it's really big. But at the same time, that stock is kind of on the upper echelon of core stocks in terms of growth. It's growing all right, especially during these crazy times with the pandemic. It's risen to the occasion to really help society out. It's done a lot of good. There's companies that are fast growers. And when it comes to fast growers, one of the examples from my own portfolio is Utz Brands Inc. This is a stock I've been buying in 2021, and it's a smaller company that is number 3 in the salty snacks category right now. And you may know them actually for their Hawaiian potato chips. Here it is. This is the Hawaiian style potato chips. This is actually a brand that came from Tim's potato chips that Utz Brands Inc. acquired. I love these chips. They are so delicious. Got the big box here showing my love for the Utz brand. And so I kind of harness my inner Peter Lynch, and Utz Brands to me seems like a modern day stock that is one that he would really like. And you'll see as we go through the video today that that will manifest in many of the lessons that come out of this. But let's keep going. And so as you can see on the screen right now, he also categorizes cyclicals. Examples, I would say, of cyclicals are Caterpillar is a good example. And so that is a stock that I personally own in my portfolio that's quite frankly done really well. Caterpillar is one that, even though it is a cyclical, it seems to have done very well in just about any market. I'll give you all another cyclical, and that is 3M Company. This is a stock recently that raised its dividend by only 1%. And I know a lot of folks in the dividend community have been unhappy with 3M raising its dividend by only 1%. So I'm showing you here the Scotch brand scissors. This is a consumer product that 3M makes. And so 3M is really big in the consumer products, but a lot of their business, a big lion's share of their business is in the industrial space. And they're actually really heavy in the aerospace segment as well. And so it's a cyclical company. And it, quite frankly, the point in time that we're at right now, they're facing a downturn cyclically in their company. Aerospace is not making a lot of investments right now. This isn't a big time for the aerospace industry, but it will rebound. And so a lot of people are kind of looking, oh, they only raised the dividend 1%. But we have to remember that 3M, it's an industrial company. It's cyclical. They're in the cyclical downturn. When they face the cyclical upturn in the future, that's when the dividend starts increasing a lot faster. And so I actually like how they're being conservative here. I think they should conserve capital. They don't know what's ahead. They don't know when the next cyclical upturn will happen. And so they're trying to be mindful of that. And that's why the dividend went up by only 1%, in my humble opinion. But let's keep going. So check it out on the screen. How else does he categorize companies? He looks at turnarounds. I think a really good example of a turnaround play is IBM, for example. That's one that I own in my portfolio. I'll talk more about that later. He also talks about asset plays. And an asset play to Peter Lynch is basically a stock that is trading below the value of all the assets that it has. And so that's how he categorizes the stocks that he likes to own. It's a little different than how I categorize mine. But again, the takeaway is to find how you would like to categorize your own stocks in your portfolio, because the purpose of dividend investing, again, in my humble opinion, is to build a team of stocks that can weather any storm into the future. And so with that, check it out on the screen right now. I want to go to the next lesson. And the next lesson is number 13. Man, I got to go a little quicker because there's a lot to cover. But he basically says that perfect stocks are not always obvious. They can be quite boring or even disagreeable. And so he's saying stocks that he likes picking are ones that sound dull, like they might have a really dull name, maybe even ridiculous. They might even have a ridiculous name. They do something dull. They do something even like disagreeable. He was talking about this company basically that is a leading producer of intestinal byproducts, particularly the casings surrounding hot dogs and sausages. He talked about a company called Safety Clean that washes greasy auto parts at gas stations. He talks about spin-offs. I thought, again, these are just some examples of perfect stocks that he likes looking for. And so speaking of spin-offs, I'm going to share some screenshots in a minute, just some stock charts. United Technologies is a stock that I've owned for a really long time. A while back, they basically merged with Raytheon. They became Raytheon Technologies. I still own it. I love that company. And they spun off Otis and Carrier. And so my whole plan going into the whole spin-off of Otis and Carrier and the merger with Raytheon was basically just to buy in. I kept buying. And then I was just going to hold it and manage it all as one unified company. And I'm really glad I took that strategy because Otis and Carrier have done really well. Let me just show you on the screen really quickly. I want to show you Otis right now first. You can see how that one has performed since it has been spun off. It's done really well. And next, I just want to show you on the screen really quickly. Check it out. This is Carrier. This is how it's done since the spinoff. And these are two positions in my portfolio. They're actually a decent size because I put a lot of money into United Tech before all of this happened, and the spinoffs have done exceptionally well for me. And I guess that's another reason these stocks are pretty good size in my portfolios, just because they've appreciated and they've done so well. And what Peter Lynch goes on to say in his book is that oftentimes spinoffs will do well because the company spinning them off wants these spinoffs to reflect well on them. They don't want them to fail because it'll just come back to haunt them. And so with that, let's talk about some other criteria or other examples of perfect stocks that Peter Lynch likes to look for. So check it out on the screen right now. He also likes stocks that institutions don't own, analysts don't follow. Again, I go back to Utz Brands Inc. These guys are all over the place now. Institutions are just starting to follow them, but they're a pretty small company. And so I like this one. He likes ones that are off the radar of the institutions. Let's keep going. And so also he would say there's even something depressing about it. He talks about a company called Service Corporation International in the funeral home business. He likes no growth industries, even negative growth industries. And so he said negative growth industries do not attract flocks of competitors. He was talking about many industries, but I know the sin stock industry is one that he kept highlighting. And I love it that he had a passion for some of these sin stocks because it's a negative growth industry. But companies can still make a lot of money in a negative growth industry if they keep having pricing power and cost control. So that was really exciting to see. What are some other examples of perfect stocks in Peter Lynch's mind? He likes ones that have a niche. He likes ones that people have to keep buying, like razor blades, going back to Gillette, a company that Procter & Gamble owns. He likes ones that are users of technology. I thought this was really cool. I shared in my last video with all of you that I had a bunch of tissues in my hands because I was crying tears of joy because Kimberly-Clark just raised their dividend by 6%. And so in Peter Lynch's book, he was talking about companies that use technology. Well, Kimberly-Clark is not a tech company, but they're now using drones in their warehouses to take inventory of all their products, their diapers, their tissues. So check it out on the screen right now. I'll show you a quick screenshot of what that looks like. This is from Kimberly-Clark in Russia. This is one of their, shout out to all my Russian subscribers out there. This is a global channel. I love everyone all around the world. And basically Kimberly-Clark in their Russian warehouses using some of this really cool drone technology to survey what they have. And so this is a user of technology. And so Peter Lynch likes that because it allows companies to expand margins, become more efficient, and grow by taking use of this technology, but they don't have to produce the technology. Let's keep going. Check it out on the screen. He likes it when the insiders are buyers, and he likes companies that buy back shares. But honestly, in more modern times, this has been abused quite a bit. So in more modern times, this is a book that was written quite some time ago. We just have to be careful about share buybacks. But they can be done in a right way if they're done through cash flow. If they're done through taking out debt, they're done the wrong way. And so moving on, we've got a lot of ground to cover, and my videos are notoriously long. Hey, everyone. Smash that like button, by the way, if you like long videos, or put in the comment below if you like these long videos, because some people say they're too long, but I put so much effort into these videos because I love you all. My videos are a little bit more infrequent, but that's because I put so much research into them, and I want to make sure that what I'm sharing here is my best content. So I never want to just do a video to do a video. I want to do the best videos, and that's why they're long. So next lesson, as you can see on the screen right now, we're up to lesson 14, is that Peter Lynch would probably avoid many of the hot stocks today. He basically said, if I could avoid a single stock, it would be the hottest stock in the hottest industry, the one that gets most favorable publicity, the one that every investor hears about in the carpool or on the commuter train, and succumbing to the social pressure often buys. We all know these stocks. These days, it's hard to be a dividend investor. My strategy is working really well. I'm already getting an abundance of cash flow. I feel really good about life, about my finances, and I've been doing it a long time, so I see the compounding working in my favor. But hey, you tell anyone these days you're a dividend investor, especially out there in social media, and they're like, hey, man, that's pretty boring. I'd rather be doing GameStop or something else. And so it's interesting that these hot stocks command so much attention, but Peter Lynch likes to avoid them. Let's keep going. And so next lesson from the book is kind of similar to the last one. Lesson 15 is avoid the whisper stock. This is another quote from the book. The stock picker is relieved of the burden of checking earnings and so forth, because usually there are no earnings. Oh man, I know this all too well. I only invest in companies that are earning a lot of money, 99% of the time at least. There are exceptions once in a while, but he goes on to say, understanding the PE ratio is no problem because there is no PE ratio, but there's no shortage of microscopes, PhDs, high hopes, and cash from the stock sale. And so this one, basically, he was talking about whisper stocks. And these are kind of these stocks that are like really hot. I think GameStop might be an example. I was in the bank the other day. I was just depositing some money, and I heard some guy in the bank like talking to the teller like, hey, I want to open up a stock brokerage account with you guys because I'm going to be buying stock here for the first time. And it would just happen to be on the day where this whole GameStop stuff was happening, and I didn't know what stock he was going to buy. I'm going to give him the benefit of the doubt and hope this gentleman was going out and buying something really good, something of really good quality. But I just had to cringe a little bit because I'm like, oh boy, what if he's getting lured into these GameStop style stocks? I don't know. But there's all these whispering, and sometimes like you're at a dinner party. Well, not anymore, I guess, with the pandemic. But before that, and someone would whisper you like a hot tip or something like that. And this is what Peter Lynch just loves to avoid. And so I think it's a really good reminder. Age-old wisdom still in effect today, still makes a lot of sense today. Let's keep going, everyone. So check it out on the screen right now. Moving on to lesson 16. This one sounds pretty easy, but it's worth remembering because he says earnings are king. And he says stock prices and earnings, they generally move in tandem over the long run. And so one of the things that baffles a lot of investors is sin stock industry. And sin stock industry volumes have been declining since the 1970s, at least here in the US. Globally, I don't know exactly, but probably same story. Volumes are declining, but these companies keep doing really well on earnings. And so what Peter Lynch basically shares with everyone is, don't worry so much about revenue. Don't worry so much about this or that. Track the earnings, because ultimately stock prices are a reflection of earnings. And that's one of the reasons that the sin stock industry, it has done all right despite kind of a shrinking industry, because they've been maniacally focused on earnings, and they've been able to get earnings through cost savings, through pricing power, earnings, they've been strong. And so ultimately stock prices are going to be a reflection of the earnings. It's just a reminder to everyone to keep an eye on that. Let's keep going. And so next lesson is number 17. And he says basically to pay attention to executives when they compliment others. He basically says that when a company gets a compliment from their competitor, that tells you something about that company, and it tells you it's probably a really good company. And so he basically says, but when an executive of one company admits he's impressed by another company, you can bet that company is doing something right. And so basically, if you're out there in the field, you're consuming media, you're researching, pay attention to what the executives say, because what they say can tell you a whole lot. Let's keep going. Check it out on the screen right now. The next lesson is it's okay to wait before investing. And so he basically says it's never too late not to invest in an unproven enterprise. He really likes to wait, and he basically goes on, I'll talk about this later in the video, but when companies are really early stage and they don't really have any earnings yet, they have an unproven business model, at least in his day when he wrote this book, he just wouldn't invest in it because he could always wait until they had a better proof of concept, they had earnings, they had momentum, and maybe the stock had even doubled, but he could still buy into it and 5x, 10x his money after getting proof of concept and taking on a lot less risk, because before the company has earnings, there's just so much more risk. Now, in terms of modern times, I would say to critique his book a bit here, this advice may be a little bit outdated, and the reason being is information now is instantaneous. Information now with the internet moves instantaneously. I would also say there's more constituents in the stock market than ever before. Back in his day, he was actually visiting companies physically. He was on the telephone. He was using a Quotron device, and so things were just different. And what I would say is maybe there was more of a lag and more of a just time to kind of process and take action. But it seems these days, at least from my investing experience, if I have a good idea, I better execute on it, because if I don't, that moment in time, that window, sometimes it disappears really quickly. And so it's just something to be cautious of, something to be cognizant of. I think his advice is still good to avoid companies without earnings and be very cautious on companies without earnings. But I also think we have to realize in modern times that things move a bit quicker, and we all have to be prepared for that. So moving on, more lessons from Peter Lynch. Man, my favorite investor. Check it out on the screen right now. And so the next one is basically lesson 19. Pick up a phone during due diligence. And so I thought this was a really good one because it's interesting. I know so many people in the community have questions. And one of the questions that popped up a while ago was on a company called Universal that I also own, ticker UVV, another kind of sin stock related company, farming industry. But basically, they were basically talking about their number of years of dividend increases, and I wanted more clarification on that, and I had some questions from the community coming in, and so I basically just emailed their investor relations. I think I might have also left some voicemails for them as well, and so they did respond to me. I don't know if I ever got the perfect answer. I kind of got other things on my plate, and so I might have lost track of it, but the fact of the matter is so many of us forget, and this is my most recent example of doing this, but I've done this some number of times over the years where I would just reach out to companies. I would call them, call the investor relations. If you own shares in a company, that company is there to answer your questions. And so don't forget that that is an option, or even if you don't own shares, if you're considering buying shares in a company, That's why the investor relations department is there for you. And I think so many of us forget those kind of strategies doing our due diligence in modern times. And so check it out on the screen right now. He goes on to say that many companies, they would welcome a chance to exchange views with an owner of 100 shares from Topeka. And so I think that's really good. And he just said, if you're on the phone at the company, ask about all the positives and negatives for the year, like what's looking good at the company, what's looking bad. Who knows, in modern times, not all companies will be as receptive, but I would imagine smaller companies are quite responsive. In fact, I have gotten some good experience just exchanging tweets with companies. I know at one point, I think 3M retweeted me. At another point, Utz Brands Inc. tweeted me. And so just engaging on social media is another way to reach out to the investor relations or the companies and just kind of pick their brain or just engage with them a little bit. So moving on, check it out on the screen right now. Another lesson from Peter Lynch, number 20, is to pay attention how companies spend their money. And I put your in quotations because, or in parentheses, because honestly, when you're a shareholder, the money being spent is your money. And so again, this kind of goes back to older times versus more modern times. But if you can see on the screen right now, what he basically says on the topic of visiting headquarters is when he visits a headquarters, he basically says rich earnings and a cheap headquarters is a great combination. And so he would tell stories of going to a headquarters and the CEO is sitting like in an old dingy office and the carpet's worn out and it's not really nice. And those are some of the best companies that he likes to invest in because he knows they care about money. They're being frugal. And I like that. I respect that. I also think, though, in more modern times, society's expectations have changed. And I'm just saying, like a lot of people, when I was buying Starbucks down in the $50 range, now it's over $100. People were critiquing me, Ian, in the pandemic, no one's going to drink Starbucks. Lo and behold, everyone's drinking Starbucks because they can't live without it. Even if it's their last dollar, I would say with younger people especially, there's just this expectation now that, hey, life is going to be a certain way and, whatever, I'm getting my Starbucks. I don't care what it costs. And so basically, society has changed a bit. And what I'm saying is there's also a certain expectation now from the workforce. Hey, an office is going to be this way or that way. And for talented people with a really good resume, they can choose where they want to work. And, the office got to be kind of nice. And so I know companies like Alphabet, for example, have a really nice office. And so again, everything I'm saying today, there's two sides to every story, but I think it is important, and I think what Peter Lynch is saying here is valid. But in the modern era, we also have to understand that in certain cases, it may make sense for the company to have a really nice office because it keeps employees there longer, retained at the company, motivated, and it just keeps people at the office longer. Some of these tech companies like Alphabet, I know they have all these amenities because they don't want people to go home. They want them just to stay there and do their job. And so that's something to be cognizant of as well. Let's keep going. Check it out on the screen right now. And so the next lesson, number 21, is great companies are found out in the field. I love this one. He talks about his wife and how she basically said, discovered this brand Legs, which was those stockings that were in those eggs that they used to have at the supermarket. I remember when I was a kid, I used to see those like near checkout stands all over the place in the supermarket. And he basically said, from the time Carolyn discovered Legs in the supermarket, and I discovered Taco Bell via the burrito, I've continued to believe that wandering through stores and tasting things is a fundamental investment strategy. And so for me, this is timeless. This is iconic. This is how I like to do things. This is how I do a lot of my market research. A lot of people here on YouTube even have critiqued me, like, Ian, you're just going through the supermarket and trying to buy up all the things that you see there. And not everything, but I buy a lot of them when the company supporting the product is really strong, like Pepsi, for example, PepsiCo or Coca-Cola Company. I love these companies. And so Peter Lynch, what he was saying is even the undiscovered brand of Legs, he was able to discover this. And I think it was later acquired by Hanes Brands or something like that. But he discovered that through his wife, which was a supermarket find. And so one thing I would say as a dividend investor, and you're scouring the planet for these new up-and-coming stocks, these high-growth stocks, these undiscovered stocks, Peter Lynch-style stocks that are really doing well and maybe are paying a dividend, paying an increasing dividend, have an opportunity to pay a really good dividend in the future. Just look what you see when you're out in the field, and also ask your kids, your wife, your spouse, your significant other, your coworkers, what are they seeing? Ask younger people. That's something that I've always found is really helpful, just understanding how are younger people looking at things these days. And so let's keep going. And so next on the list is balance sheets. And so strong balance sheets are key. He really talks about cash and cash equivalents as compared to long-term debt. He likes to look at net cash per share. He's not really concerned as much about short-term debt as long as it's kind of canceled out by inventories, but he's really concerned about long-term debt, and he likes a company that has a strong balance sheet. And so I totally agree with Peter Lynch here that it's important to have stock with a strong balance sheet. And these days, honestly, the types of balance sheets he was looking at in his day, in his book, they're a lot stronger than a lot of the balance sheets of today. Even like a company like Ford Motor, for example, a Ford Motor company, when he was explaining their balance sheet in his book, I was like, wow, that's a really good balance sheet. And I think things over time, just in general with balance sheets, have deteriorated. And so it's nice these days as a dividend investor, when I do find a company that has a nice balance sheet. An example of one that I found recently that has a fabulous balance sheet is Hormel Foods. Now, Hormel is a stock I'm buying in 2021. It's a higher growth dividend stock for me. And they just announced, or they didn't announce, it's been leaked. It's a theory that they may be in discussion with Kraft Heinz to purchase the Planters brand of nuts, including peanuts. And so I like those heart-friendly peanuts with no salt. I have those from time to time. And so I shared a post on my Instagram about that. And so head on over to my Instagram, by the way. I'll link to that in the pinned comment below if you want to check it out. I shared that on my Instagram stories, but I hope they close that deal for my... I'd love to own that iconic brand, but I do feel if Kraft Heinz sold their iconic Planters Peanuts brand, man, that company, it's just losing. I don't know how much good stuff is even left after that other than Heinz. So I do feel sorry for the Kraft Heinz camp, but I do wish everyone in Kraft Heinz all the best as well. And so let's keep going. Check it out on the screen right now. And so Peter Lynch shares next some great numbers to analyze. And so these are famous numbers. I don't have too much time to go through all of these, but I have in a variety of my different videos, but I'm going to try and focus in on some of the big ones. And so he likes to understand percent of sales. So if he's out basically in the marketplace, Peter Lynch is out and about and he sees something he really likes. Like maybe he's like me and he's at Costco and he picks up the Lay's classic mix. Well, Lay's, Doritos, Cheetos, Fritos, all that good stuff, baby. By the way, don't shame me. Don't hate on me. I was sharing my mac and cheese in a video the other day, and they're like, I said it was kind of a healthy, light lunch because I had my mac and cheese cup with some carrots and some water. And people are shaming me, man. And that mac and cheese, it's only 250 calories per serving, and it's just a 1 cup serving. And so don't hate on me. And so, hey, I like my salty snacks. I work out hard. I need the salt because I go running 7 miles. I going swimming tomorrow. Don't hate on me for having all the chips. And so anyway, Peter Lynch goes out to Costco or where not, and he sees Lay's. Wow, that's a good brand of potato chips. And then he looks up who owns Lay's. PepsiCo, my number 2 favorite stock of all time. Great dividend stock. What he likes to do is look at percent of sales. He knows that Lay's chips, that's probably a growth driver within Pepsi. And that's true. That is the growth driver, in my opinion, is Frito-Lay, the snack foods, salty snacks. Great category to be in. Everyone likes to snack. Trends are actually showing that younger people like to snack even more than older people. And I find that myself sometimes. I don't know. I guess I'm not so young anymore, but I sure like to snack. And so anyway, smaller meals, more meals, that kind of thing. But he'll look up percent of sales. What percent of PepsiCo's sales come from Frito-Lay? I don't have that number in front of me, but it's a whole heck of a lot. This is a big contributor to PepsiCo. Anyway, let's keep going. Check it out on the screen right now. And so he talks about PE ratio. Boy, I talk about that a lot on this channel. Cash position, how much cash they have. I talk about that a lot. He talks about debt versus equity. So he looks at shareholders' equity, and he also looks at how much debt there is. He looks at a debt equity ratio. I find that kind of thing really important with banks and insurance companies. He's looking at it across the board. I would say a lot of the stocks he was looking at, as I said back in the day, had better balance sheets than they do now. Just something to keep in mind for all of us. Are we getting the kind of value that Peter Lynch was back then? Can we drive the returns that Peter Lynch was back then? Is it even possible? Because what he was buying back then was really good quality at really low prices. Is that still possible? I think it is. I don't know if the compounded growth rates that he was seeing over the long run are sustainable anymore, but I surely have seen through my own experience really fabulous results, and I've shared those portfolio updates with all of you over the years here. I'll link to my last one in the description below if you'd like to check out my complete dividend portfolio and some of my performance metrics over time. Let's keep going. Check it out on the screen right now. He talks about dividends, and he really would say there's kind of two benefits to dividends. I see a lot more than two. Obviously, this is a whole channel about dividends. My whole life is about dividends. But basically, he likes dividends because they reduce a company's ability to diversify. He acknowledges that a lot of companies that have cash sitting around, they just go and they waste it. I've seen this time and time again. He also say that dividends in a down market will really save a company and minimize their downside. It kind of puts a buffer, if you will, on downside share price because the dividend bolsters the company in really tough times, meaning people are less likely to share because at least or to sell because at least they're getting dividends on their shares. Let's keep going. Check it out. He talks about book value. He talks about it can be misleading with inflated assets, but he also says certain companies like railroads understate their assets. They understate the value of their land, for example. And so book value could be something that's really interesting, but you have to look into it a lot deeper. He likes looking at cash flow because earnings don't take into effect capital expenditures. And so he likes to look at cash flow after CapEx to understand how much money companies are really making, so on and so forth. And so again, I would say the one thing that's worth mentioning here is he talks about growth rate, and really the only growth rate that matters when he's talking about the sin stocks, about Philip Morris, for example, is earnings. And I thought that was really, really key. He hammers down this point that even in declining or stagnant industries, there's a lot of money to be made. I've seen that myself. And so I want to move on. We have a lot to cover. Check it out on the screen right now. And so lesson number 24, he talks about 3 phases to any company's journey. And companies can bounce between these phases a bit. But he talks about the startup phase. He says this is the riskiest phase because companies aren't making money and they're proving their business. He usually avoids this phase. He talks about the rapid expansion phase. This is the least risky and most profitable phase. This is when companies are growing, numbers are really good, everything's growing really quickly. But then he talks about the saturation phase. He said the company kind of hits a brick wall and there's no easy way to expand. And so when I was reading the book, and I would recommend this to you if you're reading his book or any book for that matter, think how it relates to you. And one way that Peter Lynch's book, this is the second time I've read it. I'm rereading it after many years. The copy I have is kind of all messed up because it's so old. But I'm rereading it, and well, now I'm done rereading. But as I reread it, something new came to mind this time. And one of the things that came to mind is, hey, Ian, you have a company in your portfolio called IBM. And IBM's facing some challenge. Now, I'm not going to sell this company. At least at this time, I don't sell, but I'm not adding more money to it. And I think they really are perpetually at this time in this really tricky phase that Peter Lynch describes as the saturation phase. They've kind of saturated their market and they're trying now to branch out and figure out the next thing, but they're having trouble doing that. And so it'll be interesting. So they're kind of in the saturation phase, but they're also trying this risky startup phase on top of the saturation phase. And they need to make one of these startup phases that they're trying work so they can get back into the rapid expansion phase. And so that's how I could relate what he was saying back to me. And it helped me put IBM into a little bit more context. But IBM's kind of on my not so good list right now, but I'm still holding firm. I own 50 dividend stocks. If 1 or 2 in the portfolio at any given time isn't doing as well as I had hoped, it doesn't mean that I'll sell. It means I'll just step back, take pause, and kind of watch what's going on. And this is also why I personally like to diversify. Let's keep going. What's the next lesson? So the next one is number 25. I'm not even going to go into this. This is more, get a copy of the book, look at pages 227 through 233. And he basically has a stock analysis checklist that is really helpful. And it's broken down by different phases of companies, different types of companies, so that you can know what to look at when analyzing stocks. And I think 2 things that were my favorite takeaways from this section was basically be patient. And it's so interesting. I have a Facebook group, really popular, and there are a number of investors on there saying that literally because 3M stock hasn't gone anywhere recently in the last 5 years, up and down, more like way up, way down, now back way up. So it's kind of gone that way. But anyways, I got more 3M. Shout out, man. Scotch brand. So got to get the merch. I love the companies I invest in. Got to get the merch. And so 3M, though, people are losing their patience because they're then, oh man, the dividend's only been up 1%. I look at this a little different. If you look at Microsoft, I don't own this company and I won't be buying it. It's not for me, but a lot of you own it. A lot of people in the dividend community love it. And it's been going through the roof. But if you look back, kind of circa 2000 through basically 2000, I think it was 15 or so, there was about 13 to 15 years in there where it did nothing. It went nowhere. And so investors who accumulated during those 10, 15 years, though, have done really well right now. And so the fact of the matter is, again, 3M, it is in a cyclical downturn now because of the industries that they're in. It's not growing as quickly right now. I think they're weathering the storm really well, and it's great to see the 1% dividend increase. But all I'm saying is, to Peter Lynch's point, this game requires a little bit of patience, and sometimes there's stocks that I own that just shoot through the roof. I basically bought a stock, Norfolk Southern Railroad Company, shot through the roof, and I'm glad I put a lot of it in early because I didn't get any opportunities to put more in. Other companies like 3M, I've been accumulating for the last few years, and I'll keep accumulating. It hasn't gone anywhere yet, but I've got to be patient because this is a game of patience. Anyways, with that, let's go on to the next one. Peter Lynch basically says to set your sights high. The stock market is a lot of work, and if you're not really buying an index fund, ETF, that kind of thing, he says that 12 to 15% per year should be the goal. And so I think, hey, that's a reasonable goal. I'll leave it at that. I'm not so sure that's easily attainable in the modern day, especially given how far the market has rallied at this particular moment in time in 2021 in February. But you know what? That's a commendable goal. And I agree with him that all of the work, it is a lot of work. It should garner results above and beyond the index. And so I think that's a valid point from Peter Lynch. Let's keep going. And so the next one, lesson number 27, all right, we're making some progress here, is he likes to basically swing trade those stalwarts a bit. And so he will rotate in and out of stalwarts for like 45% or 40% or so gains. And so what's an example of a stalwart? Again, it's something like a Coca-Cola company. And so these are the kind of slower growing companies, slow and steady. They're not going out of business. They're doing really well. Personally, I think a lot of growth is ahead of Coca-Cola, and I look at these a little different than Peter Lynch. I look at them more like Microsoft, if you will. There's going to be periods of consolidation or slower growth. There's going to be periods of more rapid growth. In Coca-Cola, over the last decade, it's been a period of slower growth. The next decade, though, I think it could be a little quicker for Coca-Cola. But needless to say, what he does, and I don't do this, I buy and hold forever, but I'm sharing Peter Lynch's insights today. He gets kind of a gain on one of these stalwarts, and he feels like it's a little overvalued as compared to another stalwart. What he'll do is sell the one, put the money in the cheaper one, and he kind of recycles that strategy over and over for some really nice gains. But that doesn't align with my long-term buy and hold forever dividend strategy, but it's worked really well for Peter Lynch, who is someone who, quite frankly, has had a lot of success with his investing. And so who are you going to listen to, him or me? I don't know. I listen to myself, but most people probably better off listening to Peter Lynch. I don't know. But I think it's really valid when you're an investor and you're kind of set in a certain mode like I am. It's always good to look at different viewpoints to get in the full picture, even though I'm not going to change my way as I like to look at it. Let's keep going. Check it out on the screen right now. And so the next one is lesson 28. This is so cool to hear that basically to avoid the noise. He basically says when someone tells you something about a stock, It's really difficult to get it out of your brain, and you have to be careful what they're telling you, and especially when they're telling you to sell. He said he sold too many stocks really early because someone told him something, and then he acted on it. And so I'll tell you, I got a little bit of critique on this. In my Facebook group, I basically made a policy that I want no negativity. Now, it's okay to come in with a constructive viewpoint. Hey, Ian, I disagree with you on 3M for this, that, and the other reason, because I actually took the time to read their annual report and I did some mathematical analysis on their numbers and I deciphered this. What do you think? That's totally cool. I'm saying I don't want people coming into the group and saying, hey, Ian, 3M is a junk company, and then they show a picture with like a dumpster fire. Not cool. And the reason for this is these negative things, they do tend to stick with you. And I would say also negativity, even if it's subconscious, it keeps you back. And this is a community about growth. This is a community about building wealth. This is a community about living our best lives. And so I just kind of realized in recent years, if I have kind of negative things coming my way, maybe I'll give someone 1 or 2 chances, but at a certain point, I just block it out of my life. I'm even talking about my personal Facebook, just political stuff. Anyone posting like too much political stuff, I'm at the point where I just unfriend them. And so it's, I don't need a big circle. I rather have a small circle. And so for me, again, I kind of resonate with what Peter Lynch is saying, because these things, you just got to block it out, because if you just focus on the positives and you focus on moving forward, there is so much that all of us are capable of when it comes to the stock market or honestly anything else in life. And so I thought that's really good message from Peter. Let's keep going. Check it out on the screen right now. Okay, and so the next one is lesson 29, and it really comes off the last one, lesson 28. It's very similar, but he says avoid dumb ideas. And he basically says these days dumb ideas are at a deafening roar. Man, I would love to know what Peter Lynch thinks about social media, because these days, if he thought back then it was a deafening roar based on what he was reading in the newspaper or saw on television, with social media and the internet, oh my goodness, there's so much noise. And this is just something I preach over and over, is right now a lot of dividend investors, I see this in my Facebook group, they're starting to question, or they're even thinking, is this the right thing for me? Everyone else is doing something different. They're doing growth stocks, they're doing IPOs, they're doing SPACs, they're doing cryptos, they're doing all kinds of different stuff. They're doing GameStop, they're doing all these things. And I'm not saying any of those are bad strategies. Everyone has to find the strategy that works for them. But what I have found is, for me, dividends are the best strategy. And sometimes I have found when there's a lot of noise, I kind of start thinking, well, I mean, of course, I'm never going to abandon dividends, but I start thinking, hey, I got some money. Should I throw it at this, that, or the other? And I have to avoid those temptations. And if I have to avoid those temptations, I know in this amazing community, 70,000+ of us, there are others out there feeling the way that I feel. And so I think it's really important to understand that there's a lot of dumb ideas out there. And again, I don't want to put people down, because I hope that people with these other ideas do really well, but sometimes you just got to stick with your gut. And so I thought that was really good from Peter Lynch. Keep going. Check it out on the screen right now. All right, lesson 30. We're getting there. We're getting towards the end. I got a lot to go through. But he basically says he likes to know when to sell. And he has a whole checklist on pages 251 through 257 on when to sell. Now, this didn't resonate with me as much, because I typically never sell. But I just want to point this out to everyone, because I'm unique. I'm an anomaly. I buy and I hold forever. Peter Lynch is not that way. Peter Lynch's track record is better than my track record. Peter Lynch's track record is probably better than anyone's track record, or most people's track record. And so I'm just saying, I got to look at what other viewpoints say, and he has a whole checklist on when he sells. But I'm one of those people that doesn't sell. Let's keep going. Check it out on the screen right now. So lesson 31, conservative stocks can carry great risks. And so I thought this was really healthy and important to take in, because we buy certain stocks like utilities. We take it for granted that a regulated electric utility is going to do just fine. But what we don't remember is, hey, there can be a problem with a nuclear power plant, and if there is, it's devastating. It can put the entire company under and just create mass devastation out there. Horrible. And so I think Peter Lynch just reminds us to all question that, is a conservative investment, is it really conservative? Is it really less risk? A lot of the time, not necessarily. And so you're taking on the same risk or maybe even more risk for lower returns. And so he questions things that way. And I think it's really important. Let's keep going. Check it out on the screen. Next one is lesson 32. Investors can be very impatient. And he basically says, it's taking too long for anything to ever happen. Well, just ask those Microsoft shareholders from back in the day who were accumulating 2000, 2010, that kind of range. I think they've been rewarded really well for their patience. And so Peter Lynch says, don't be impatient. Let's keep going. Check it out on the screen right now. He says that investors in lesson 33, they spend too much time worrying about lost opportunities. He says in many ways, like investors like to torture themselves. Like, look at all the money I've lost. I didn't buy it. You didn't lose money if you didn't buy it, but they look at lost opportunity cost. He quotes, the worst part of this kind of thinking is that it leads people to try to play catch up, buying stocks they shouldn't buy, if only to protect themselves from losing more than they've already quote unquote lost. This usually results in real losses. This point is so important, especially for any investor, but especially if you're a newer investor. You're buying dividend stocks. You're buying your 3M. It hasn't gone anywhere. You see your friend up all this money in something else. You just torture yourself. You're like, why are they richer than me? Why did they make more money than me? First and foremost, you have to realize that everyone in this world is on a different path. We're all on different journeys. It doesn't matter if someone has more money, someone has less. We all have a unique purpose. We all want to do our best and optimize within what we're given, what we have. Money isn't everything either. Money definitely does not equal happiness. And so the guy with more money, not necessarily more happy. We know that for sure. I know that for sure, just based on everything I've learned over my life. And so, and that I've seen out there play out, especially in Silicon Valley with a lot of rich people who are just not happy. And so, although I wish everyone happiness, but this game of, oh my God, this guy made all this money, so now I really got to go take risks to try to catch up. That is such a losing proposition. The reason I love dividend stocks is the comfort of it all. The cash flow, it's predictable, it works, it takes time, it's get rich slowly, but it's definitely a get rich strategy. Companies like 3M, they allow me to pay my bills, pay me cash flow that I can use to pay my bills while I sleep. And so let's keep going. Check it out on the screen right now. We're getting there. Lesson 34, be careful shorting stocks. Infinity is where a shorted stock always appears to be heading. And so I love this. And so it's very timely with what's going on with GameStop and some of those other stocks that have been shorted very aggressively. I don't short, and this is why. When you're long, you can lose 100% of your money. When you short, you can lose infinite money. And so after all of this, I took some time just to reflect on the book and what are some of my takeaways? How do I draw all this back to my current situation right now, February 2021, dividend investor. I own 50 stocks. I've been doing this for over 20 years. Married, I have 2 kids. I'm at that stage in life, like really thinking critically about everything, thinking about the future. What did I take out of this book? What are some of the other takeaways other than what I've already mentioned? Check it out on the screen right now. And so the more I read through his perfect stocks, the more I thought about my good old sin stocks. And so Peter Lynch, man, you gave me some renewed confidence in my sin stocks. I might be buying some more of those. Everyone hates them. But boy, are they trading at attractive valuations. And from all I've been able to decipher, they're doing just fine. They're making a lot more money than some of these hot stocks. These, what did he call it? He called it these dumb ideas in some cases. They're making a lot more money than that. He also writes about some of his favorite stock picks. And I think what's really interesting is one of his favorite picks at one time, or one of the stocks he touted in his book at a time, was GE. We all know what happens with GE. It fell out of favor. It did really bad. The company collapsed. Disaster. And so basically what that told me is the best investor, one of the best investors of all time. He touts stocks in this book that was written quite some time ago. You look fast forward to today, and those stocks, some of them are doing really well, some of them are not doing so well. And this is a reminder to me that my strategy is buy and hold forever. People in the community have warned me about this. Ian, when you buy and hold forever, how can you guarantee these stocks will stand the test of time? I can't, because the good example is going back to GE from Peter Lynch. Now, GE may have another day. It may turn itself around and hit new all-time highs at some point. I don't see that happening, though. I really don't. And so I think it's a reminder that, hey, yeah, I buy and hold forever, but there may be some selective pruning that I have to do. Or even if it's not selective pruning, I do it just through dollar allocation. Right now, I'm not adding more money to IBM. I'm going to let that thing prove itself. I'm not going to sell it, but I'm not adding to it. And so there's other ways to get around that as well. But I think it's a reminder to me, in the community, I got to be real to myself, being buy and hold forever, that, yeah, out of my 50 stocks, when I look forward 50 years from now, it's possible that a few of them are either out of business or facing serious challenges. But another point Peter Lynch makes is that the winners will go up 5, 10x. They'll way outperform the losers, because the losers, you only lose 100% of your money in the worst case. And so it all works out. The investor still comes out way, way ahead. But yeah, I think it's a good point. Now, also worth noting is I do buy the stalwarts, as he calls it, or core stocks, as I tell it. And core stocks in general are kind of not stocks that are generally going to go out of business, because even GE, they're still chugging along. I guess it could be considered a core stock or a stalwart of types, but yeah, they're not going out of business. So let's keep going. What else did I learn? How else did I bring it back to myself? Basically, actually, that's about it. I already talked about this one, but just what phase is IBM in? This book got me thinking about IBM. All right, everyone, I hope you enjoyed my video review today of Peter Lynch's One Up on Wall Street. If you enjoyed the video, please go ahead and smash that like button. It means the world to me. Please go ahead also and subscribe to my channel, because I have a lot of good videos on the way. You do not want to miss out. Also, I have a Patreon. If you want even more content, I have 19 bonus videos that you will receive immediately when you join my Patreon. Check it out. I'll include a link in the pinned comment below. I have over 100 patrons over there right now, and we have a really good discussion going on over there as well. It's a great way to support what I'm doing here on YouTube as well. I can use all of the proceeds from Patreon to upgrade my equipment, and I have been. You may notice that my lighting is a lot better, and one of the reasons for that is my generous patrons. Thank you for contributing to my journey here on YouTube. I love you all. Before I leave today, I want to do a full disclosure. In terms of full disclosure, I own a huge amount of the stocks that were discussed today. And so the stocks that I own are Utz Brands Inc., ticker symbol UTZ. I am long 3M, ticker symbol MMM. I am long PepsiCo, ticker symbol PEP. I am long Kimberly-Clark, ticker symbol KMB. I am long Coca-Cola, ticker symbol KO. I am also long Altria, ticker symbol MO. BTI, ticker symbol BTI, and Philip Morris, ticker symbol PM, the SIN stocks, Thug Life Investing. I own all of those. I am also long Carrier, ticker symbol CARR, Otis, ticker symbol OTIS, those spinoffs that I love so much. I am long IBM, ticker symbol IBM, although you're not on my good list right now. I am long Starbucks. I love you, Starbucks, ticker symbol SBUX. I am long Procter & Gamble, ticker symbol PG. Procter & Gamble, baby. Man, I love this company. What an amazing, amazing company. I am long Caterpillar, ticker symbol CAT, Universal, UVV. I am long Hormel, ticker symbol HRL, and I am long Norfolk Southern, ticker symbol NSC. I own all of those stocks in my personal dividend stock portfolio. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's really possible to lose money in the stock market, especially where we are at now with all the volatility, all the craziness, a potentially bubble of sorts, if you will. There's a lot going on right now, although I love my dividend stocks. Again, not investment advice, just sharing my journey. I love you all. I will see you in the next dividend investing video.